Let's talk more about markets. Kathryn Rooney Vera is Chief Market Strategist at StoneX Group. Kathryn, good to have you with us. Thanks so much for being with us. I got to ask you, when you hear Jay Powell wrapping up his testimony at Capitol Hill, so far we know one more rate hike is scheduled for July. That's what markets are pricing in. What happens after that?
That's the real question. It's not whether he hikes or the Fed hikes once or twice more at 25 basis points a pop. It's, is the next move subsequent to that a cut, or is it further hikes? I think that depends on the trajectory of inflation. I think the market is discounting the seriousness of the Fed with regard to its 2% inflation target. So will they keep will they keep rates at a terminal rate of 5.5% perhaps for an extended period of time over the course of maybe the entirety of 2024? That would be a negative for the markets, especially the equity markets, which are clearly discounting a far more dovish Fed than Jay Powell is trying to convey.
A lot of it depends on data, doesn't it? We have jobs data. What kind of indications will the Fed need when deciding what to do next?
Well, that has to do, of course, with the service sector and inflation therein. We have the super core index, which is something that we economists look at quite closely in determining what the Fed might do next. But what I've been primarily focused on for an extended period of time, Christine, is the labor market. The labor market here in the U.S. has been red hot. We're at full employment. We have a fiscal deficit of 6% of GDP, which is pretty significant. And we see no signs of real turnover in the labor market. Yes, initial jobless claims have been coming out slightly higher, but an unemployment rate of 3.7% is inconsistent with the 2% target of the Federal Reserve. So my bet is that the markets are underestimating the willingness and the commitment of the Fed to getting to that 2% target. I do not think that the Fed is going to cut before hitting that target, as arbitrary as it might be. Now, a lot of analysts are expecting the Fed to change the target or to cut before hitting the target. And I think those market participants are going to be disappointed.
Kathryn, this is Martin. Good to see you again. So I know this is sort of theoretical, but just for the sake of conversation, you're saying that 3.7 unemployment is not consistent if you want 2% inflation. How high do you think, or I mean, you've probably done the math and modeled this, right? How high do you think unemployment needs to go to be consistent with 2% inflation?
Well, the NAREU is the non-accelerating inflation rate of unemployment, and it's hotly contested and debated among economists. Many correctly say that the range of the calculated NAREU is too wide to really be able to estimate with precision. But my estimate is around 5% of unemployment, and we're at about 3.7. So moving from 3.7 to 5%. Historically is consistent with recession being the next phase of the economic cycle. Now, Wall Street, the big shops on Wall Street are divided between who believes that we can nail a soft landing or a no landing, and those of us that think recession is in the offing. And I think it comes down to do with the stability of the consumer, Martin. Here in the U.S., consumption is 2/3 of the economy. So while the consumer remains resilient and confident and has a job and continues to earn more year over year, he or she is going to continue in their normal habits of consumption. Now, that said, I'll finalize with this. The equity markets are very strong. Of course, we've seen a pullback in the past couple of days, but the fixed income markets, especially the 2-10s curve, continues to be massively inverted. And even our rates team at StoneX has been looking at this and saying at some point, we need to start adding on steepeners onto our portfolio positioning.
All right. Are you agreed, Kathryn, that for unemployment to continue to go up, maybe even hit that 5% theoretical level that you think is consistent with the 2% inflation, JOLTS, job openings, they are going to have to come down?
That's absolutely correct. And there's something called the Beveridge curve, which indicates this very close relationship. And it's an inverse one in the sense that more job openings generally are consistent with a low unemployment rate. That's where we're at right now. We still have more than 10 million jobs vacant here in the U.S. That's about 1.8 times the amount of unemployed people. That has to come down. So that's one leading indicator I think we can look at to ascertain when the unemployment rate is going to jump. Now, on the flip side, Martin, the soft landing would contend that, and rightly so, if real wages become positive consistently, persistently, and aggressively so, then that goes in favor of the soft landing camp. We have not yet seen that happen.
Kathryn, you're a strategist, and just a couple of seconds ago, we were showing folks on another screen right next to you, Indian Prime Minister Narendra Modi arriving at the White House for that big state dinner, black tie affair, etc. I mean, this is the full deal. He's going to be meeting Tim Cook, Satya Nadella, a lot of big tech CEOs, right? This is significant. You know, a couple of days ago, we were talking about how Secretary of State Anthony Blinken's visit to China. People are watching that very closely for any signs that tensions are easing. Because from the super macro perspective, 30,000 feet, if you do see that, I mean, it makes a huge difference to sentiment as well as obviously to fund flows. This Modi visit to the U.S., the elephant in the room obviously is China. If the U.S. can get India more on side, then it's got, I guess, more marbles to play with as it continues to try to confront China. So how closely are you watching this Modi visit, and how much of a difference do you think it's going to make?
Well, emerging markets face an uphill battle in general from India to China, especially since we've seen the reopening trade in China pale in comparison to what we saw here in the U.S. when the consumer came back with a vengeance and equities followed suit. In fact, the Chinese reopening has been dismal in terms of its impact on commodity imports therein, as well as in Chinese equities. They've been pretty hard hit. Same with India. I think emerging markets in general face a difficult situation in going forward, especially in the equity space. I think there are more opportunities in fixed income, but facing a difficult road ahead with recession on the horizon, a Chinese recovery which has been less than what many have expected, and the outlook for inflation indicating that the developed markets are going to have to keep hiking, which takes away the attractiveness of the carry, which of course is the difference between what developed markets yield and what emerging markets yield.